So hope everyone is having a great day. I'm really excited to do this webinar. Jenna and I have been talking about this for some time, and this is a term that I use all the time when talking to clients or doing presentations. And I say, not all money is created equally. And that's what we're going to unpack. I'm going to give some different examples about that. So this is a live webinar. So just be aware, if you have questions, we absolutely want to make this interactive and get your questions answered. So my name is Tyler Braun. I'm the Director of Financial Planning with the Tranel Financial Group. On the bottom of your screen, if you have a question as I go through things, there's a Q&A button. Feel free to click that Q&A button and type in any questions that you have. I have Jenna Bradford, who's the president of the Tranel Financial Group, on this webinar here with me. She'll be able to get your message and then read it to me or get it over to me so I can get it answered. So with that being said, we're going to get started. So not all money is created equally. So the first thing we always do is start with an agenda. And as we look through here, really what we're going to cover is 5 different items. Number 1, I want to talk about the approach to looking at your assets differently. We need to address a time horizon for your money. Taxes, right? We always have to talk about taxes. Legacy, and throughout this presentation, there's going to be examples and stories that we're going to bring all of this full circle. So when I say, or when you hear that not all money is created equally, I want you to put these 5 aspects into account and ask yourself those questions, right? What's the approach to looking at the assets? What's the time horizon, taxes, legacy? And then we're going to address those questions going forward. So first thing we look at when we're asking those questions, I want you to always think, what is the goal with my money? What is my money working towards? What is my time horizon? And what options do I have? So any scenario we're about to share, what is the goal of my money? What are we working towards? How long or what's the time horizon for that money? And what options do I have? Okay, so with that, let's get started. Not all money is created equal. So first example that we're going to give is a Roth 401k and a traditional 401k. So when you look at this, right, and you hear that example, when do you need the money in this example? Well, typically, most people need a 401k when they retire, right? It's a retirement vehicle that you're adding to or accumulating for a long period of time. And a question we get all the time since Roth 401ks have come available, should I add to a Roth or should I add to the traditional 401k? So when do you need the money? Retirement, check. Okay. What is the money going to be used for? So in that example, the money is most likely going to be used for generating some form of income in retirement, or for those very fortunate individuals that might have Social Securities and pensions and things like that. Maybe it's used to pass on to the next generation, right? What is the goal that is most important to you? And then what's the best result for that individual? And the best result might be that, hey, I want to pay as little in taxes as possible, or I want to hold on to as much of my money as possible, or I want my asset to grow as much as possible. So when we start looking at it and addressing those questions, and a client asks me, hey, should I add to a traditional 401k or to a Roth 401k? Let's look at the math here. So when I say not all dollars are created equally, in this example, I'm literally showing both individuals. So this is for a 25-year-old. Let's say a 25-year-old, let's say it's your child, grandchild, a friend of yours, or just you when you were 25 years old, are adding $10,000 per year. Okay. And let's stick on the 401k that's traditional here, pre-tax. And let's say that you did that for 40 years. So you contributed $10,000 a year to your 401k, and you did that for a 40-year period. And let's say it grew at 7% per year. Okay. If we did that, if you added $10,000 per year for 40 years at a 7% growth rate, that money would grow to be $1.996 million by age 65, right? At 40 years on top of 25 is age 65. If you said, you know what, I'm 65 years old, I want to start taking a distribution from my 401k at this point, right? I want to start withdrawing. With a traditional 401k, the advantage is you're putting money in pre-tax, meaning you're not taxed on any contributions. That money grows tax deferred. And when you get to the point where you want to start taking distributions, you pay ordinary income tax only on what you withdraw, okay? Only on what you take out. So in this example, let's say you're withdrawing 5% of your 1.996 million. So you're at $99,000 per year is what you're withdrawing. Well, at 99,000, let's assume you're in a 25% tax bracket. That means you're going to pay $24,954 on the $99,000 distribution that you took. Now, if we did that for a 25-year time period, so from age 65 to age 90, you would have paid a total of $623,859 in taxes on that money. Okay, so you grew to 1.996. You're taking roughly $100,000 per year out of the account at a 25% tax rate. You pay a total of $623,000 over a 25-year time period in taxes. That account is also subjected to the RMD, required minimum distribution. And when the time comes that you do pass away, your kids or beneficiaries are also going to pay taxes on those when they inherit that beneficiary IRA. Okay. Now let's look at a Roth 401k. So with a Roth, the difference that you have is you're paying the taxes up front when you make the contribution. So if we're looking at apples to apples, you can see if you add $10,000 per year post-tax, and we do the same thing for 40 years at a 7% growth rate, okay, what we're really doing is you're contributing $10,000 after tax, but it's going to cost you $3,333 in taxes each year if you're in a 25% tax bracket. So this is where the numbers can tell us the immediate truth. If you had to pay an extra $3,333 in taxes, and we did that for 40 years, the total tax you paid on the Roth 401k is $133,000. You will never pay another tax on the $1.996 million again. There's no required minimum distribution, and your kids inherit the money 100% tax-free from the beneficiary Roth IRA once you pass. Look at the difference in taxes, apples to apples. It's almost a $480,000 difference in taxation in this example between the traditional 401k and the Roth 401k if you have time on your side. So the reason I share this is not all money is created equal. Most people think in their mind, they're saying, well, I'm adding to a 401k. Boom, perfect. You should add to a 401k, but adding to the right type of 401k is the difference between paying almost 3 times as much in tax later on compared to the Roth 401k of having time on your side to compound and grow 100% tax-free. That is not the example for every person. I don't want you to leave here and say, oh, I should do a Roth right now. Every person's different, and your age is very indicative of when you should do a Roth 401k versus a traditional 401k. The older you are or closer to retirement, the less time you have to let that money grow. The traditional can become more advantageous at that point. So just for this scenario, for younger investors, the Roth 401k, I always joke around, is a no-brainer, right? And that's the end of conversation. It's a one-time tax on that money that you'll never pay tax on again. It's awesome. Next piece that we look at, where we say not all money is created equal, is the emergency fund. So we talk about this. So when I say emergency fund, this would be like liquid cash, savings, checking account. I talk to a lot of clients, and when I talk to people, one thing they have in common is they're all really, really busy, and it becomes difficult to check in and make sure that they're doing everything as efficiently as possible. One of the things I've run into here lately is people that have an excess in checking and savings. I'm right there with you. I want you to have a very healthy emergency fund. So certified financial planning doctrine says you should have at least 3 to 6 months worth of living expenses. A lot of clients have 1 to 2 years, and that's okay. If that brings you security and a safety net, I'm okay with it. We just need to make sure it's working for your benefit. This is where not all money is created equally as well. If you have money in a checking and savings, the average interest rate right now, so this is if you're at a Chase or a PNC or a lot of the big institutions, is 0.02%. So there's many clients that I talk to that might have $100,000 in checking and savings, and they're getting 0.02% interest on their money. And what they're being told is, hey, it's FDIC insured, so there's no risk. It's my safety net. I'm not too worried about it. Well, $100,000 at 0.02% is $200 a year of interest. Interest rates have been elevated from where they were at historical lows. And they've been elevated for about a year now at higher interest rates that we have the ability to take advantage of. So when we look at apples to apples, ask yourself the question, not all money is created equally. If we look at other alternatives, whether it's a money market or a CD, okay? A money market, I always joke, is like a savings account on steroids. It's an account that with a savings account, you can put money in or take money out as many times per month as you'd like to. With a money market, you can still put money in and take money out. You can just do it 6 times per month. For most people, right, have your checking account, then put the lion's share of your assets in a money market, and you still have complete access to them at any time. It's still FDIC insured, meaning there's still no risk associated with it, and it's insured through the Federal Deposit Corporation, right? And what we're seeing is it's gaining 4.5% to 5% interest. So if we look at those same numbers and you have $100,000, even if we use the smaller of the two in the example, 4.5% of $100,000 is $4,500 per year. You're making more interest on a monthly basis in example 2 than you did all of year 1 in option 1. Think about that. $4,500, right, divided by 12, you're making just under $400 per month of interest, which is almost double what you made in an entire year in option 1. So make sure if you have that, what we would call lazy money or money that's there as the emergency fund that's on the sideline, make sure that it's working for you to its fullest potential. And if you ask yourself, what's the time horizon of the money? Well, the time horizon of the money in this example is we want it to be liquid. Both options here are completely liquid. The next piece that we look at is from a taxation standpoint or from a goal with the money. The goal is to have it be secured and tax efficient, right? Well, you're making more money on your money, right? Even if you have to claim a little bit more interest on your taxes, you're still netting substantially more, right? Even if you're in a 10% tax bracket and you showed $4,500 of extra income, that's $450 of taxes you would have had to pay. But guess what? You still made over $4,000 in interest compared to $200. Still exponentially more, right? So we need to look at it. Not every dollar is created equal. Not every account is created equal either. The third piece that I want to talk about here is really understanding and addressing what's most important to a client and dissecting those different pieces. So Vanessa here, Vanessa's mother, I put Vanessa's home on here. Vanessa was the name of a mother of a client of mine. The client came in, we sat down. Vanessa had just moved into hospice and was not doing very well. She wanted her assets to go to her kids efficiently, and that was her main goal. She had a lot of assets. She was a great saver, had built up this large portfolio. She had long-term care insurance, really was at a point where she wasn't worried or stressed about her finances. And the kids got together, including my client, and they were going to sell Vanessa's home just to reduce that burden. Vanessa was never going to go back home. They didn't know how long she was going to live for, and they were going to sell the home for her. And I immediately said, stop. And she kind of looked at me and she's like, well, why would I stop? And why would I not sell the home at this point? And I said, there's a difference. Not all dollars are created equal. Yes, if you sell it, you're going to get cash in hand right now. But the tax treatment of that sale is going to be completely different. So the first question that I asked the client is I said, how much did Vanessa buy her home for years and years ago? Vanessa was very fortunate. She had bought her house for about $100,000 over 40 years ago. And currently, because of the location, it was worth about $800,000. I said, if Vanessa sells this home, she is going to pay a capital gains tax because she is still alive on the gain of the home. Now, what you get is you get a $250,000 exemption per person on your primary residence if you've lived there 2 of the previous 5 years. Vanessa qualified for that. So in that example, if she bought it for 100 and she gets another 250,000 of exemption for gain, that means her cost basis would be 350,000. If her kids sold that house while Vanessa is still alive, taxes are owed on the gain between 800 and 350,000. They would pay a capital gains tax on $450,000. So let's assume a 20% tax rate on 450,000, right? We're talking a substantial amount of taxes, almost $100,000 in taxes that would be due in that example. I told the client, I said, listen, I know that we want to clean this up, but Vanessa's goal is to leave the money as efficiently as possible to the kids and reducing any burden. It's just her and her sister for my client, right? So it's just my client and her sister were the only 2 beneficiaries. I said, would your mom want you to sell the house and have that $100,000 go to you and your sister? Or would she rather have you pay that $100,000 to the IRS for taxes? And she's like, well, she would absolutely want it to go to me and my sister. So I said, we need to calm down. So we took the time, we sat down, we mapped out a plan. Vanessa ended up passing away about 2 months later. And what we need to be aware of when I say not all dollars are created equal, in example 1 that I just shared, they would have sold the house and would have sold it for $800,000 and would have had to owe about $100,000 in taxes on that money. After Vanessa had passed away, they sold that house for $800,000. But since they were the beneficiaries of the account, they received what's called a stepped up cost basis on that property, meaning they inherited the property at the value of the date of Vanessa's passing. So the house was worth $800,000 when she passed away. That means the girls inherited it at $800,000. So when they sold the property for $800,000, there was no taxable gain to report, and they saved $100,000. So when I say not all assets or all money is created equal, that $800,000 selling it prior to Vanessa's passing versus after was a $100,000 tax liability difference that they were able to save. So we need to be aware of what moving parts are in place whenever you're looking through a transaction. Okay. And remember, if you have questions as I go through these, just make sure you click right at the bottom where it says Q&A. I'm happy to go further into detail or dive through different dynamics that may be in place with some of these, because there are a lot of one-offs that can come up with this. So next piece we're going to look at here is something that clients run into all the time. So Nick and Beth are clients of mine. This is a stock photo, so this is not a photo actually of them. So Nick and Beth are clients. When we sat down, there was a frustration that they had the very first time we met. And they said, we've been investing for a substantial amount of time, but we feel like we can't get ahead and we end up owing taxes every year and don't understand why. And I want you to think, do you fall into that category? Have you ever gotten a tax bill at the end of the year and thought, I don't know why I even got this 1099. I didn't personally buy or sell anything. What ended up happening with Nick and Beth is one of the largest tax efficiencies that we see with after-tax money. So I'm not talking about IRAs, I'm not talking about Roths, I'm not talking about 401ks. I'm talking about money that you invested that was already taxed. So it went into a joint account, a trust account, etc. It's after-tax dollars. This is directly off of Morningstar. I'm not going to show you the mutual fund that this is tied to, but one of the terms, the first term that I'd like to show you that I highlighted there is the term that's called turnover. So Nick and Beth were invested in one mutual fund. They had over $300,000 in that one fund. And you can see inside of that fund, remember, a mutual fund is a bucket of companies. And there's also what's called a mutual fund manager that is buying and selling those various companies behind the scenes because their job is to get the highest return for that fund. So that's what's tracked here when you see the term turnover. So when I broke through Nick and Beth's statement, I could immediately see that 27% of that mutual fund that they owned was being turned over, which means it was being bought or sold. And anytime you buy or sell something in an after-tax account, that creates turnover, and turnover can be taxable if there's a gain involved. The next piece that you can see here is directly off of Morningstar as well, which is that third-party rating company, right? You can see the potential capital gains exposure for the fund, meaning of the fund's holdings, 32% of those holdings have a capital gain attached to them, meaning that when they sell something, they're going to pay taxes, even though they didn't sell it, the internal money manager did. So as we look through that, I started to dissect exactly what Nick and Beth were running into. $300,000 portfolio times the 27% turnover we talked about means that $81,000 per year was being bought and sold inside of that fund. They just didn't know it. Of the $81,000 that's being bought and sold, 32% of that holding, which is listed right here under the potential capital gains exposure, 32% of that holding, right, was subjected to a capital gain, which means now on their 1099, Nick and Beth just realized $25,920 of a capital gain that they weren't even aware of. They're in a 15% tax bracket, and they live in Illinois, which has a state tax of about 5%, which means they're going to pay 20% on that capital gain. So they owed $5,184 in taxes on that $300,000 investment when they didn't even sell a single holding. It was all done internally inside of that fund. So the reason I share that not all money is created equal in that example is because we want to be extremely efficient with after-tax money, because what can happen is you can have something that you hold but don't necessarily understand how it's being worked by the internal money manager that can create a tax burden later on. So in this example with Nick and Beth, what we were able to do is position them differently going forward to avoid that tax drag, or what we call a tax trap, where taxes are occurring in the background that you have no control over. We want to take control of that and put that 5184 back in your pocket, because once you spend that money on taxes, it's gone, right? That's the biggest piece that we look at. All right. My last story here for today is about Nick. And this is a unique story. Nick is a client of mine and is a real estate developer on the side. So what he does is he'll go in and he'll buy a home and he'll fix it up. And after he fixes up the house, he'll turn around and either rent it out or sell it for a profit. So Nick had gotten found a property that was a good deal. This was about 3 years ago. Had found a property that was a really nice deal. Had asked another partner to join him on the property, and the partner had declined him at the time. Nick went and acquired the property, and after his partner learned what the property cost was, how much he bought the property for, what he did is then in turn said, no, I'd like to partake. And Nick said, hey, we've partnered before, and brought him into the fold. So now the two of them owned a property together, but the property was only under Nick's name. They never took the steps to move it to an LLC or any other vehicle where they were both associated with it. They both put time in. They had an agreement that they wrote out that they were both part owners of the property, but the deed to the property and the mortgage to the property were solely tied to Nick. When Nick went to sell the property, they had about $100,000 gain from the value of what they bought it for, what they put into it, and what they were selling that property for. So they had $100,000 of gain that would be taxable at a long-term capital gains rate because they held it for more than 1 year and 1 day. Immediately, Nick said, I'm going to do what's called a 1031 exchange. So what a 1031 exchange is, taking those dollars from an investment property and he wanted to invest them in the next investment property. And he said, I'm going to pay my partner out because he doesn't want to partake in this new investment property with me. And I said, okay, how are you going to pay your partner? Because I don't think he fully understood how much of a mess he had created. In his mind, he was going to take $50,000 because that's his partner's 50% of the profit and gift that to them over a 2-year period, because you can gift up to $18,000 per person. He and his wife were going to gift over that money to them. And then they were going to have their $50,000. Nick was 1031ing the money into the next investment property, so he wasn't going to have to pay any taxes right now. And I said, do not do that. Do not do that. And he kind of looked at me and I said, the reason you don't want to do that is when you 1031 the gain into the next property, your original cost basis goes with or goes to that next property. So if you're going to gift after-tax money to your partner, he's never partaking in paying his taxes at all, and you are now paying the taxes for him. So if Nick were to gift him $50,000, that's a gift. Meaning when he 1031'd all the money to the new property, that $100,000 of gain is now still tied to Nick, not his partner, and his partner walked away 100% tax-free. Nick would have been incurring all of the taxes on his portion plus his partner's portion. I said, you need to work with your accountants and work this out because it's not really a gift that's occurring. It's a business transaction that occurred, and there's taxes that are due by your partner, not by you. Not all money, right? In their mind, $50,000 was going to the business partner, $50,000 was staying with Nick, but not all money is created equal. That is a tax liability that would have been incurred by one party and not by the other. So we need to be aware, any transaction that's occurring, you need to ask yourself, what's the most opportunistic and value of these assets? I talk about it all the time when we're doing legacy planning and we're sitting down with clients, is I would rather see a beneficiary or your children inherit after-tax money or Roth money than IRA money. And everybody kind of looks at me, and the reason they do that is after-tax money gets a step up in cost basis, no taxes. Roth IRA money gets 10 years post-death, tax-free. IRA money is a 10-year spend down, and the children have to pay taxes on that. Same thing if you're getting into higher income earner families or higher value estates where we have to worry about the inheritance tax. You don't want to have to pay an inheritance tax with an IRA because now you're paying taxes and then paying even more taxes, right? Think about it. If you had to pay a $500,000 inheritance tax bill out of an IRA and you took $500,000 out of the IRA to do it, you just paid taxes with the IRA, but now you owe taxes on that $500,000 you took out, right? It just starts to snowball. So it becomes very important to plan accordingly to know exactly which assets you should use, when, and why. Okay. With that being said, so we're right at the 30-minute mark, which is exactly what I planned for today. The takeaway is you need to have a plan for whatever goals you have for your assets. You need to take the time to sit down and with your advisor and write those out and just know what are the takeaways and what items do we need to work on going forward and why, to make sure it's efficient as possible. With that being said, I'm going to leave a few minutes here at the end for any questions that we have. Jenna, do we have any questions that came through at all?
We do have a couple of one question that specifically came through.
Okay.
And this was during Nick and Beth's story. And I don't know if you want to go back to those slides, but this was during
Sure.
their story. It says, what was the value of their account after the sales and paying taxes?
So that's a great question. So the anytime you have a mutual fund, which is what I'm referring to here with after-tax money, if you're at $300,000 and let's say your 300,000 went down, let's say the market went down and your 300,000 is now worth 280,000, you can still pay capital gains tax. A mutual fund is, if used inefficiently, is one of the only vehicles that you can actually own, have a loss, but it's a pooled investment, right? If that money manager internally sold something that they've held for 20 years at a big gain, you could still end up having to pay taxes on an investment that went from 300,000 to 280,000. If the investment started at 300,000 and ended the year at 300,000, but they still turned over 27% of the portfolio and sold something in there that had a 32% capital gains exposure, you're still going to pay $5,184, even though the portfolio didn't grow at all and stayed at 300,000. So the ending portfolio value in this example doesn't matter. In a perfect world, right? Let's say it was 300,000, it grew to 320,000, and taxes owed were 5,184. You pay those 5,184 out of pocket. Most people are not selling the asset to turn around and pay the taxes, because what would happen is if you bought it for 300 and it's worth 320 and you had to sell it to pay the $5,184 in taxes, you're now incurring even more capital gains because you bought it at 300, it's worth 320. You have to pay taxes on that gain as well. You start to see, Jenna, how complex this gets and how inefficient it can become if done improperly. So yeah, in this example, it doesn't matter what it ended at, because it's internally what the fund is doing and buying and selling. And this is a true example. This is literally the mutual fund that Nick and Beth held in that example. And I pulled those numbers right off of Morningstar.
Okay, wow, thank you. I appreciate you answering that. That's a really good point, because we do think about the end goal when in actuality that doesn't always matter at times. So thank
Right.
you. I have no further questions that were asked. So that's it. Thank you,
Perfect.
Tyler.
Absolutely. So if anybody has any other questions, please feel free to reach out. Appreciate everybody on here. Hope you have a great rest of your day, and we'll talk to you soon.